Well, good morning. I call to order the meeting of January 27th of the Murfreesboro Electric Department Pension Committee meeting. Let's start with a brief prayer, if we could. Bow your heads. Dear Father, we thank you for the opportunity to gather together on this beautiful morning that you've provided to us. We ask for your wisdom and discernment as we go through these important matters. In Jesus' name, amen. We'll say a Pledge of Allegiance real quick. Stand up. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. All right. First order of business is consider the minutes of July 21st, 2021. Good morning, Adam.
I make a motion to approve the minutes.
A second.
Good. Do we do roll call? Can we just do?
Yeah, I can do that.
You want to do roll call? Okay.
Okay, I'm Craig Tyndall
Aye.
and Charlie Riggs
Aye.
and Jackie
Aye.
and Melissa Wright.
Aye.
Good. Okay. Next order. We want to welcome Matthew Gilliland from Findlay, and he has a presentation, the annual review of the pension plan. Matthew.
Hi, thank you. So if you have in front of you the USI Murfreesboro Electric Pension Plan Department annual review. We can start with that. So a little bit of background by myself before I start. I'm taking over the plan for Michael Guyton. Michael has been the actuary for quite some time, and he retired last year, and so I've taken over for him. I've worked under Michael for 13 years since I've been working for the company. We were BPS&M and then Findlay, and now you'll see that we're actually USI now. We were purchased a little bit over a year ago. And USI is a huge company. We've got lots of services that are now available that weren't available to us just under Findlay. But that's a little background about myself. And starting off, we can skip the agenda slide and just go straight into the actuarial valuation. Let's see. On slide 2. A pension plan's financial position is measured based on several different things. The plan provisions, which is what tells how the benefits defined for each participant. The participants and their different factors, their age and stuff like that. And then the plan assets and the actuarial assumptions and methods. And all of those work together to determine the plan's financial position. On the next slide, the funding method. It's a systematic approach to determine current benefits, a present value of benefits for the plan, which gives a current liability, and we compare that to the assets. You can see how well funded the plan is. Just a little, I guess, actuarial background. The plan uses an entry-age normal funding method with an unfunded accrued liability being recognized immediately. That's fairly common for plans like yours. Ultimately, the cost of the plan is benefits paid less the investment income. So as benefits go out and the investment income comes in, any difference there would be the cost of the plan. On slide 5, I've put in the plan provisions. I don't know how new some of you are to this, so we'll run through the plan provisions just briefly. The plan was closed on April 1st of 2012, and then frozen effective on 6/30/2020. And at that point, there were no more actives. The plan is effectively frozen. All the benefits are set where they are as of that date. The benefit formula is 2% of the average compensation multiplied by the years of credited service, limited to a maximum of 30 years. The normal retirement age under the plan is age 60, but participants may retire at age 55 if they have 10 years of service. And then there are several options currently available to participants. The normal form is a life annuity, an annuity which will be paid monthly for the remainder of that participant's life. But there are also forms to guarantee 5, 10, or 15 years with a life annuity. and forms that allow a joint survivor, like a spouse, to continue the benefit after the participant, if the participant were to pass away before the survivor, then they could get 50%, 75%, or 100% survivorship. All of those options do have a reduction to get to a different annuity, and that's defined by the plan. And then also, if the benefit's small, under $10,000 currently, then there is a lump sum option. As far as the funding's concerned, what our actuarial assumptions, what we use to value the current benefit of the current liabilities of the plan and benefit of the plan is 7% investment return. We use a mortality table, which is set by the Society of Actuaries. It's a standard mortality table. It's the RP 2014 mortality table. And then annually, the Society of Actuaries provides us a mortality improvement scale, which we can use on that mortality table to show how advances in technology and in healthcare improve mortality over time. And that current table is MP 2020, and that changes annually to keep up with assumptions that the SOA sets. So those are kind of general assumptions over all of the U.S. population, lots of data points that goes into that. So it's kind of a good general overview of mortality. As far as the retirement rate, since the plan's small, we assume that all participants retire at age 60, which is fairly common for a small plan. Participants may retire early. There may be some difference in that expectation, which could get gains or losses, but our current assumption is age 60. And then the plan expenses are expected to equal the prior year's expenses. The participants' information on slide 7, we have 64 retirees and 45 deferred vesteds, so a little bit over 100 participants in the plan. The average retiree age is 70, and then the average deferred vested, and the deferred vested is someone who is not yet started their benefits, where the retiree would be someone who is in payment. The average deferred vested age is 47. And then you see the average retirement benefits there. For the retiree, it's a little bit over 2,100, and then for the deferred vested, it's a little bit over 1,900. As far as the valuation results, the accrued liability is $23.4 million, and the actual value of assets is $31.6 million. And if you take those, you've got more assets than what we're valuing for the liabilities, and so that has no unfunded accrued liability. The plan is fully funded based on our assumptions. And since it's fully funded, overfunded, essentially, there's no contribution required. I'll briefly stop there and just to make sure there are no questions on the valuation, the funding valuation side.
Any questions? No. Good. Thank you, man.
Some risks that may concern you with the pension plan. A main risk for most plans is interest rate risk. Your plan is set at the 7%, which is typical for governmental plans to set it to the long-term rate of return. And if that ever changes, if we ever decide to change that, maybe because the long-term rate of return decreases, any decreases in interest rates will increase the liabilities. And also that second note there, that the current rate is not applicable if you wanted to ever terminate the plan and purchase annuities. The current annuity market is much lower than 7%, so those interest rates would significantly increase the liabilities. So if you were to go and purchase annuities for all the participants, it would be more than what we've valued here for funding purposes. But at the 7% rate, you're well funded. The contribution risk, there's currently no contribution risk expected. Since there's no contribution expected, and on the long term, I wouldn't expect one given the overfunding of the plan on our 7% basis. However, if it was terminated and that cost of annuities was more than the assets, there could be a need for contribution at that point. There is more longevity risk in this plan than most because all of the participants are now inactive. You've got a significant retiree percentage. So people living longer may increase the liability. So that is something, generally that longevity risk is one of the smaller risks, but it is something that this plan should consider. And the demographic risk is very low. There are no active participants, so our assumptions, our actuarial assumptions are minimal. We've got the retirement age at age 60, so really the main demographic risks are people retiring different than our assumptions. So if they're retiring later or if they're retiring earlier, that might give some gain losses to the plan, but it's very low for this plan. I'll move on to the accounting work. The GASB 68, and these are similar numbers to what you have in the funding, but you've got a little bit different ways in which things are valued. The market value of assets for the accounting work is $31.6 million, whereas the actuarial accrued liability on an accounting basis is $23.4 million, and then you've got the net position of an overfunding of about $8.2 million there. The funded percentage of about 135%. So well funded on the accounting basis. With the accounting work, we calculate the pension expense. That is the expense that goes on to the city's account. When they do their accounting work, it'll go and be included in that. And that pension expense from the plan consists of service cost, which for this plan is zero. There are no accruing participants. There's no service cost. Interest cost, and that is interest on the current liability over the year. And then it's minus projected investment earnings. And then any difference in experience will be amortized. And the amortization is over the expected future lifetime of all participants, the average future lifetime of all participants. And then any investment gains or losses are amortized over 5 years. And then we also add in that administrative expense, which was the prior year's expense, is what we've assumed for that. And so that goes in and gets you your total pension expense. And so looking at slide 12, we've got the pension expense for the year ending 6/30/2021. Like I said, no service cost. There's the interest cost, about $1.6 million. The investment returns are subtracted off. We had about 1.9 in investment returns. Some recognition of some losses in the year, demographic economic losses of about 183,000 there. And then our investment gains for the year were about 790,000. And then recognition of outstanding economic demographic gains or losses. We had a recognition of losses of 266,000 and a recognition of some investment losses of 75,000. And then changes in the assumptions added another 204,000 roughly. And the plan expenses of 132,000. And that gets a total pension expense, which is actually a negative, so it's a pension surplus of 221,959 for the plan. And so that's the gist of the accounting results and the funding results. I do have another part to this slide, but I think we're going to cover that later, the slide, section 13. So I'll stop at this point, and if there are no questions, or check if there are any questions.
Any questions? Good. Thank you, Matthew. Appreciate it. So we'll move then to Ms. Holland from Pinnacle Bank for her review. Good morning.
My screen. He's a little finicky, isn't he? Good morning.
Morning.
I believe most of you have it on your screen in front of you, and then there's a hard copy there. In the hard copy that I've provided at the beginning is the quarter end for September 30. I think we're going to focus on the December year-end information that we've got here. So this is a format that most of you are familiar with, maybe one or two of you not so much. But if you turn to page 3, where that is up there, you'll see a recap, and I've given you that information for the last 6 months ending December 31st, and then a 1 year ending December 31st. And we're using that cost to market statement. So these numbers, the last time we were here, we had made that change, and so that continues here. But we'll focus on the 1 year ending December 31st. The beginning cost was $25,582,024. You can see the dividends and interest collected in the plan were $914,000 roughly. We had some accrued income. We paid benefits in 2021 in the amount of $1,710,824. The expense of the plan was $140,000. There's realized gains of $608,000, some accrued income of $88,000, unrealized gains in the plan of $6,777,414. And we wound up the year with a market value of $26,629. We began the year from a market value perspective at about $30 million, so our market value changed in the course of 2020 after paying those benefits to the tune of $1,750,000. So I've included just a year-end snapshot. These are the assets and the information that you see in the year-end statement. If you look at that when you get the year-end statement, I think the most important thing here is just to kind of look at the overall allocation. At the end of the year, we had $1,643,377 in money market. We pay benefits to the tune of roughly $140,000 to $150,000 a month. So we pay it at the rate of about $1.8 million. We'd had a couple bond maturities as we pushed into the end of the year. So that cash is a little higher than we typically keep it. So we were looking to replace some of those bonds. The stocks were 61.7%, or $19,700,762. About 33% in the fixed income or bond piece of the portfolio. So $10,593,000, and then you'll see that market value at $31,938,126. So we have maturities or bonds maturing in the portfolio. They ladder out probably 7 or 8 years, but we have about $1.3 million rolling off coming up in 2022. We're at about that $1.1 million to $1.8 million in bond maturities probably for the next 4 or 5 years. That gives us the ability to have cash available for payments if the market's not behaving, so we don't have to sell anything on the equity side of things. But it also gives us the ability to go ahead and reinvest those dollars. Do you need me? Reinvest those dollars if rates are improving. Rates have improved a little bit. Interest rates are still pretty dismal, but they have jumped up. The 10-year has jumped up significantly. On the short end of the yield curve, we see more opportunity in that 1 to 3 year space. You're not incented to go out any farther. So when reinvesting those bonds right now, we're kind of staying in that window. So this is just a sample of the holdings. I know you guys are familiar with all of this. So unless you have any questions, we'll push through the holdings in the portfolio, and then there's more detail as we get to the back. Okay. So I placed this page a little differently than you've seen it in the past. This is the entire account performance, so the total account return. And we've got the 1 year, the 3 year, and the 5 year number. So total performance for the portfolio. So for the calendar year ending December, the account returned 11.77%. The 3 year, that's an annualized average. It's 13.65%, and the 5 year is 8.7%. And then we're going to drill down a little bit into what the equities did, the fixed income did, and some indices to compare and a benchmark. I've got that for you a little bit later. next page is just kind of a breakdown of the bonds or the fixed income piece of the portfolio, but what's important to see here is if you look down the 1231 column, you see that 3.69. That's the average maturity of the bonds in the portfolio. So as I mentioned, it's still relatively short, and when we're replacing those, we're still staying relatively short. You can see that the yield to maturity has creeped up a little bit since the end of September. That's indicative of rates climbing just a little bit. And then the bottom left shows you the quality of the portfolio, so everything needs to be investment grade or better. We own some treasuries in the portfolio. We own a couple CDs in the portfolio. The bulk of the portfolio is corporate bonds that are investment grade or better in quality. And then the bottom right is just the allocation as far as when those bonds actually mature. And you see by far the largest is in that intermediate sector, that short in that intermediate sector. The next slide takes a look at how those bonds did. So not great. In rising interest rate environments, bonds don't tend to perform very well. We've got a one-year number that's down 82 basis points versus that Barclays aggregate intermediate benchmark of down 1.29. Excuse me. The 3-year, the bonds have averaged 3.71%, and the 5-year, it's 2.9. So rising interest rate environments create a struggle for the bonds that you're currently holding in the portfolio. Rates get better, your rates are lower, that market value swings the direction you don't want it to go. So we're keeping it fairly short. They did provide some stability in the more turbulent markets. A couple years ago, you had a little more stability through the ownership of these bonds. But for 2021, that number was down 82 basis points. The equity piece of the portfolio, this just shows you that 82.5% is in domestic markets, the U.S. market, and about 17.5% are in international markets. This slide shows us the performance of the stocks in the portfolio. So for 12 months ending December 31st, your stock component was up 21.5%. And then I've shared with you, and I stepped back and took a look at the investment policy statement to see if it spoke to specific benchmarks to use in this particular plan, and there wasn't one, so I've shared several benchmarks with you. I've got the Russell 3000, which is more inclusive. It includes large cap, small cap, and mid cap names, which are all owned in this portfolio. That MSCI ACWI ex-US is an international benchmark, and then I've shared the S&P 500, and that MSCI EFA is also an international benchmark, so you can kind of see how things stack up. But the one-year number, your portfolio, 21.5% on the equity side, 3 years, annualized at a 22.84, and the 5-year at 14.3%. So great year in the equities market. I mean, 2020 and 2021 were better than I think anyone anticipated. And those results are shown here on this page. When I was here last time, I'm not sure who asked, but someone had asked to show kind of a summary of the purchase and sales or activity in the portfolio, so I've included that. So the next page is just what I've bought and sold in the portfolio for last calendar year. So it's very busy. In March and in June, there was some rebalancing, so there's a fair amount of equity trading. There's a lot of bonds being replaced in the portfolio. And then towards the end of the year, we had a couple additions on the individual stock side, and you will see those in this summary as well. And if you guys don't want to see that, just let me know. I can't recall who asked about it. This core equity strategy is the strategy that we're using for the individual stocks in the portfolio. So when we look at the equity sleeve of this portfolio, about 65% of it is in individual stocks, large cap growth type stocks. And that's what this gives you a snapshot or summary of. The balance is in using mutual funds or exchange traded funds, and we're buying small and mid cap and international type. Well, I just blew through that, didn't I? So I guess if anybody's been paying attention to the market the last couple days, it's a little bit like a whiplash. So I'll speak to that if anybody has an interest in kind of what our thoughts are positioning the portfolio going forward. So it has been a crazy couple weeks. The last couple days specifically, you see the market swing, 800 points intraday. Everybody's paying attention to the Fed. The Fed met yesterday. Every time they come out and speak, they talk about We might, raise interest rates 3 times. Well, we might raise them 4 times. Well, this morning I read people are ranging from 5 to 7 times we might raise interest rates this calendar year, and where typically they've raised them at 25 basis point increments. Somebody's thrown out into the universe for people to get worried about. Maybe we'll do that in 50 basis point increments. So that really the market tends to react quickly and then digest information and kind of step back. I mean, even yesterday you sell off and then you close the day up. So there is no doubt that I believe we will see interest rates, and that rise in interest rates be a little quicker and more often that we had anticipated, and rolling off that balance sheet quicker than folks had anticipated. So the big direction we're going, again, on the fixed income side of things, is staying in that, as we replace them, in that 1 to 3 year, where you tend to be getting a little bit more incentive and a steeper yield curve. That's where we're replacing those bonds. We're keeping ourselves short. And then on the equity side of things, in owning those individual names, in these types of environments, value tends to outperform growth. So stocks that like to pay a dividend tend to do better. So, looking for names within that portfolio that might benefit or hold up better in more volatile times. So just strap in, put your seatbelt on. It might not be the same as it has been in the last couple of years, but still a lot of positive things. Earnings are going on right now, and they're kind of a mixed bag right now. So not as rosy as, last quarter earnings, but still a lot of positives in the market. Does anybody have any questions I can answer for them? No?
No questions?
All right, thank you.
Thank you, Tammy, appreciate it. Good. Let's see, next item is information on the, well, we did that, didn't we?
They also gave us September information in the
Right.
same booklet.
Yeah, and September's in there. So I think we're down to other business. So one of the things that we would like to do, and what Matthew alluded to, is to, from the administration side, what we'd like to do is to survey the participants in the plan to gauge an interest on lump sum payouts, and whether they would, and how many individuals would be interested in lump sum payouts. So I asked Matthew to talk a little bit about that, and then and we can answer it. He can answer any questions, or I can answer any questions on what we're thinking about along those lines. Go ahead, Matthew.
If you would pull up the slide 13 of the USI presentation. See if I can get it here on the screen.
Oh, you need some help?
Yeah. How does it come up? Sorry.
It's not coming up on the screens. He may have cut that off.
Well, anyway, going to the presentation, slide 13. We had some discussion with the city about potentially adding a lump sum payment for participants, a full lump sum payment. This would be separate from the 10,000 small lump sum payment. And that 10,000 small lump sum payment, we did look at that, and there's currently no participants that are eligible for that. Everyone would be above that amount, so no one has the ability for a lump sum currently. And that would be paying the benefit, thank you. That would be paying the benefit completely to the participant in one payment, so they would no longer have payments from the plan, and they would be responsible then for managing and taking money out of that as they wish. So since they would no longer be in the plan, it would reduce the plan from longevity risk, the risk that participants live longer than expected, and it would also reduce market risk, any fluctuations in the market, since we paid that out. So the plan would no longer bear that. Conversely, the participant would then bear those risks. It would be the participant's responsibility to invest those and take on that market risk. And if the participant lives longer or doesn't live as long, they would have to manage that longevity risk as well. So participants could transfer the benefit to a qualified plan and take no tax penalties at the time of payment. So they could go over to something like the MTE's 401k plan if they're still active over there, or they could roll it over to their own IRA, where they would have control over that money and how it was invested and managed, and still be allowed to use that as a tax sheltered plan for retirement. If they could also choose to have it paid directly to them, and that would be subject to taxation, any taxation laws. And so in that case, you might see, like, if typically if a participant takes a lump sum, the IRS subjects them to a 20% mandatory tax withholding. When they actually do their taxes, that might be different, but that's what the IRS does on a typical lump sum. So they would be subject to taxes if they didn't roll that over into some qualified retirement plan. And there is a risk anytime you offer lump sum payments to participants. There's a risk those participants know their health and know their situation better than anyone else. And so if there's someone in poor health, they could take the lump sum knowing that they might not live so many more years, and that lump sum might be very beneficial to them. So they could take that, and then conversely, someone who's very healthy and knows maybe their parents have lived to 100 or something like that. They've got good family history of living a long time. Those participants could say, well, I'm going to take the annuity. Why would I take the lump sum and take on that risk? I'll take the annuity. And so there is some play there that participants could do to potentially get some anti-selection benefit against the plan. So that's something to consider also when considering a lump sum payment. Are there any questions about the risks or the potential impacts to the plan?
I think well, I was going to say, at this point, what we would like to do is really just survey and see how much interest there is out there for the participants to explore the lump sum, and then we can tell what the effect then would be on the plan a little bit better than just guessing right now as to how many people would take it. So what we're looking at doing over the next few months is to put together I don't want to say a postcard, it's probably old school, but some way to communicate with plan participants and have them respond and say whether or not they're interested in exploring it further.
So you would provide their payout, cash payout amount on the form so they know what they're,
I think we probably provide
an estimate.
Yeah, an estimate.
Wouldn't be
because-
exact.
Yeah, because we're not going to know when we're going to do it.
And it
Obviously,
depends on the interest rates at the time you do it too, so.
Yeah, it might. So we'd have to look at those things, but we can give probably some indication of perhaps of what it might look like for an individual, yeah.
Would that payout be calculated at the 7%, or is it a reduced amount?
So that payout, you would be able to select the assumptions for that lump sum payout. It's not currently in the plan provisions, so any actuarial equivalence factor to determine what that lump sum amount is would be defined when you add that amendment. Currently, the plan for the annuities, the plan uses a mortality table called UP84, and it uses 5%. So currently, the way that the annuities are adjusted is a 5% interest rate. So that's a very common sense one to use since it's already in the plan.
Seven's way too high, I think.
Well, yeah, but seven's done for the purposes of accounting.
For the return on the
Yeah.
investment.
Seven is the funding, the long-term expected return assumption. 5% is what's currently used for other annuities. But the city has options to choose any kind of actuarial equivalence when they make that amendment.
Would there be so I guess there would be an option if you didn't want the payment to get an annuity and,
That's right.
Yeah.
Yeah, you can't force
Yeah.
anyone to take a lump sum, so.
okay, that's
Yeah.
good to know.
Yeah.
Because we have a retired that's 95 years old, how much lump sum?
Yeah, he might be interested if he's that old.
Yeah, might be a good proposition, but first, I think we need to see the effect on the plan before I don't want anybody to misinterpret that we're going down this road just yet. I
This
mean,
is
I
just
think
an evaluation.
This is an evaluation to see what potentially it would look like, and how much interest is out there. And it really comes from, I mean, I was asked a few times in the past before the plan was closed out as to whether we would amend the plan and do a lump sum. There was a couple people that were interested in doing that, so it's kind of a follow-up on that as well.
Well, if you have a former employee that has 10 or 15 years in, it might be, you know, they might be more inclined to take the cash out.
Yeah, everybody's circumstance can be a little different, but yeah, they might be, and then if they did it tax-free and rolled it into an existing 401K or IRA, then, you know, it's a good thing for them.
I just hate to get up every morning and worry about the market.
It's good for you, it's good for your heart.
No, no.
Yeah, Tammy will tell you it's good for her heart, they watch it. Good, thank you, man.
All right.
Appreciate it. All right, any other business? Hearing none, I guess we'll close the board meeting. Appreciate everybody's time and being here. Thank you all.